Connections, I think we talked about that a lot, but again, connecting with the people in your industry, your state, whatever it might be, so that it may reduce your capital need, I think is important. And continuity. Early stage companies, in my opinion, cannot afford to have high turnover, particularly at the executive or management level. I actually had a conference call this morning with a company that's more in a turnaround mode, but CFO problems, and deciding maybe the CFO they had is not the CFO that they need to have. And we had to talk about that. Okay, that comes at a price. You know, you're going to have to bring in a new CFO who really in this company was truly the number two, and that number two needs to be recognized as the number two by the employees and lenders will be concerned and investors will be concerned. I think it's the right decision in this case, but you can't do that lightly. So when I talk about these things, I'm talking internal training team and external team. I think we all know what the internal team is, although I've kind of added on there strategic advisors, we already talked about strategic investors, but strategic advisors, again, you can't always get everybody to say yes, but if you've got a good idea, if you've got a good plan, and if you can get some of those strategic advisors who have connections or just have experience that can really help you and actually reduce your funding risk and help you if they're involved, that may open doors at your bank, open doors with investors, those sorts of things. One thing probably goes without saying, but I hear it too often, is I hear companies say that they have a strategic or an advisory relationship with, and I'm not going to drop a name, but names that people, again, it's Iowa, everybody knows certain names. You know, if you don't really know Warren Buffett, don't say that you have an advisory relationship with Warren Buffett. You know, that kind of thing undermines you in this situation. External team, obviously, in my opinion, is critical. They have good attorneys, good accountants, good bankers. Investment bankers you may or may not need. It just depends on what you're doing. But it doesn't hurt to meet with those folks. They usually have time. They're generally less focused on project finance than they are on what I'll call, you know, equity capitalization. But they do work in the project finance area, and they can help you. Again, those folks are very connected. This is not a bullet point just to be self-serving. It's really, really important in my opinion that you have your business and your financial and legal house in order. And it's way easier if you do it from the start than if you do it later on. This applies to all types of projects and all sorts of companies. Corporate documents and minutes, you know, the LegalZoom example, you know, I've had clients who have come to me who use LegalZoom or substitutes for that to organize their companies, and maybe did a lot of other sort of doing things on their own, thinking they were being efficient. You know, we talk about capital efficiency. I can argue that's probably capital inefficiency because they had actually been very successful. The company I had in mind, actually most people here would know the name because they really executed very well. They had poorly organized their company. They had issued equity to several people who had no business having equity, and there was no vesting requirement or anything like that. It wasn't like you had to stay as an employee of the company for 3 years or anything like that. It was actual equity out there, and so then when they had, in this case, a large investor, a large strategic investor willing to write a 7-figure check, before we could even really go to them credibly, we had to clean up the mess. And sometimes you can't clean it up. Usually you can. But once in a while, and this is usually a later stage company, but once in a while, it's just such a mess that you don't have much in terms of alternatives. So keep that corporate and capital table in order. Governing documents, contracts with owners, you know, what are those relationships? Investors are very, and banks, lenders are very focused on what is the relationship with the owners. Are we running all of their personal expenses through the company? If you are, I don't think it'll be the death knell for you, because I know bankers and investors have seen that sort of thing. But it'd be better if you're not, and it'd be better if you stopped if you are. Material contracts, again, it's a risk-benefit thing, it's a cost-benefit thing, so if you can afford to have your important contracts reviewed by your lawyers or carefully looked at, do that. Protection of your intellectual property, same thing. You gotta have a budget for it. Probably, if people have patentable technology, you probably can't patent everything because you'll run out of money. But there are things like provisional patents, trade secrets policies, non-competes. You know, the one thing that I'm not an employment it's really important to tell people. You hear these people say all the time, well, non-competes aren't worth the paper they're written on. It's not true in the state of Iowa. And in the state of Iowa, if you're a company that has key employees, you won't get all of them to sign them sometimes, but if you can get them, they're very important to protect your intellectual property. As are assigning their inventions, assigning their intellectual property to you, so you have property with the company, keep your financials, accounting records in order, tax returns, and others. Let's see, we're running a little shy on time. I'll move pretty quickly. Actually, it looks like this really was a very basic overview. So I don't know how many people here actually really want to talk too much about raising capital. These themes, I think, are generally to cut across to you if you're looking for renewing a term loan or renewing a line of credit or something. We already talked about know your business plan, know your valuation. If you're raising equity, and it needs to be very clear to you what value you place on your company. Because if the investor says, if I write you a check for $3 million, what percentage of the company will I get? You need to have an answer to that. You need to have an answer. It needs to be a realistic answer. You can obviously start from a higher valuation, you normally will. But if it's just crazy, I think you lose credibility. And if you don't know how to value it, you can engage a firm, usually an accounting firm, an investment banking firm, somebody in that world, who can help you come up with some sort of evaluation. Doesn't have to be an appraisal, but some sort of evaluation. The big investors will do their own valuation, but you need to have a credible story. Know your projections. What is going to happen if you get their money? Know your audience. Who are they? Why do they want to invest in you? What motivates them? If you're talking to an angel investor or a seed capital fund or a VC fund or any of the above, know what industry they invest in. You can usually find that information. If you can, talk to people who, if you can't find it publicly, talk to people who might know about it. If you're in an industry, if you're in light manufacturing in a particular niche, and they just lost, $5 million in light manufacturing in that same niche, that might be good, that might be bad, but you want to know it. You want to know it. Know your subject matter, your competition, and your market. You may not be putting together a PPM or an offering document, but know those things. Quality presentation materials, that probably goes without saying, but a lot of times people do with pitch materials that just aren't very solid. Context, we've kind of talked about who are you presenting to, because your presentation and your delivery will be very different. If you're talking to, Uncle Ralph about investing in your company, that'll be very different than if you're talking to a VC fund. They'll dig deeper in your context areas. What stage? Proof of concept. Do you have a new technology or a new product, a new piece of equipment that nobody's seen perform yet? Are you a development stage company? Have you got past proof of concept that you're kind of rolling out R&D and development? Or was it growth and expansion capital? Your leverage and your choices on funding are different depending on those stages. What do you want and for what purpose? That answer can be kind of fluid. I mean, it might be that you'd be willing to, if you can get traditional debt, you'd rather get that than equity. But what are you going to do with the money? What do you want? What is the bargain that you're offering to your investors? Or in the case of your lender, what is the amount you need and what do you need it for? Okay, conclusions, and we'll have just a few minutes for Q&A. I've got about 10 minutes left, I think. Financing world has changed permanently. The investing world has changed permanently. That's of course my observation. You certainly don't have to agree with that, but I think these changes are here to stay. I don't think that's all that. I think if you have a good company with a good plan, good management, good team, you will be able to execute. And frankly, sifting out some of the weaker players is not bad if you're strong. It's not bad if you're an investor. It's not bad if you're a company in an industry. Consider and access all sources of financing, training, financing alternatives that we talked about, connections, contacts, strategic relationships, all of those things. Again, I think that is something that has always enhanced success of companies in the past. I think it's something that now determines success or failure. Business plan is critical. Again, it's not the piece of paper or the words on a piece of paper. It's the concepts, but in detail. How are you going to execute? How are you going to succeed? How will you make sales and get to cash flow positive? Your team is critical. I think that, I know I've hit that theme many times, but I think it's absolutely critical. And if you have to build out your team, again, another positive about, well, it's kind of a positive and a negative about the state of Iowa, is it's easy to contact people and say, we're looking for a quality CFO in the manufacturing industry, or a quality CEO or CIO, whatever it might be. There are people that can connect you either to those types of candidates or people who know those candidates. And I'm not saying anything bad about search firms. I've got some really good friends and good clients that are in search firms. But I'm not really talking about that. I'm talking about people that have personal relationships with people that they're confident will work in your business. The bad part about our state is we're still pretty lean in terms of candidates for those types of positions, so it can be hard to find somebody. Strategic relationships, again, I know I've hit that really hard, but there are folks out there, including folks who folks like me who charge hourly oftentimes, but not hourly to establish connections and strategic relationships. That's good for me, that's good for you, it's good for all of us. All the success that we can drive to our companies and our state is good for all of us. Business plan, team, preparation, execution, and timing still determine success. Be prepared to pitch. I'm really just talking about, the pitch is the buzzword for when you're out raising equity, but really be prepared if you have a capital need or a funding need. Know the sources, know as much information as you can. Absolutely know your company and what your need is, what your plan is to execute. And then in my opinion, if you can do those things, a successful financing and capital raise is generally going to follow. With that, what I'd like to do, actually one more thing I would say, that I didn't have on here, but is this concept I mentioned about is reducing risk from the perspective of the investor, from the perspective of the lender. Making a bankable or investable company is really important now. And depending on your stage, you probably can't. I mean, very few companies can say it's almost, it's without risk. And your lawyer will tell you not to say that. But you can reduce risk. For example, if there are proven ways of doing certain things, and you got a different idea that let's say might shave off, let's say it's a $20 million project, and you think maybe you'll do more of the EPC contract work or some of the subcontracting work yourself and save, let's say that contract is $3 million and you're going to save $25,000. Think about the trade-off. Is that lender going to look and say you're capable of doing that, or is it going to be the equivalent of you being the general contractor on the construction of your own home if you don't know anything about it? If you can execute, you can make your lenders or your investors happy with that, then maybe it's capital efficiency. If you can't, it's risk. It's risk to bankers, it's risk to investors. So if you can de-risk your project and make it bankable and make your company investable, I think that's in your best interest. So if it's not broke, you may not need to fix it. With that, I would open it up to questions and answers. Yes?
Chris, how available, in your opinion, is venture capital in the state of Iowa? And I may have a follow-up depending on your answer.
How available is venture capital?
Yeah, in the state of Iowa.
Okay, in the state of Iowa, that's the question. How available is venture capital in the state of Iowa? Increasingly, but still difficult. So I mean, a good example would be, I've met with venture funds recently from Kansas City, from New Mexico, from Minnesota, all looking at the Midwest and looking at early stage in some cases too. We're not a flyover state anymore. The fund of funds has helped out, but the reality is there still is a perception that our companies looking for venture funding are somewhat unsophisticated and don't know how to present to those companies, and so we need to get past that. I actually had a conversation this morning that was disappointing with someone who, a serial entrepreneur who's done several startups, very successful exits. He's on his fourth, and is now doing one in a venture-backed company in Iowa. And his statement to me, which I don't agree with, I want to make that clear, but he said a short period of time to be in the state, and he said, the work ethic in this state on startups is just not what it needs to be. People just don't understand the effort that's needed for an early stage company to get to the finish line. Now my view is, by the way, that he stepped in